Hello, everyone. Welcome to Smart Investing. Today is March 6th, Wednesday, the year 2024. So, we have these two stocks that we're going over for the banking services sector. Markets are open, so when I do show you charts, you're going to see some movement. So, just so you guys know, so there's going to be some price instability going up and down. So, let's begin. The first stock that we have is ticker symbol CFG. Citizens Financial Group. So this stock is pretty active in volume. First thing I noticed, like always, going over this first page. So market cap is 15.4 billion. The 52-week high and 52-week low, a difference of at least $10. So we have around $18. So the earnings per share is at 3.1. Dividend is at 1.68. PE ratio is at 10.7. Next earnings are at 4/17/2024. So looking at this stock, do they have good numbers, decent numbers, or bad numbers? It's pretty decent, but again, just the sector alone is kind of tricky. It can, drastically go down in like several hours. So again, this company, so far it looks okay. But again, we're going to further dive into more numbers. The chart for the last 5 days, it looks like it's been going up. If we look at the last 5 years, in 2021, it's gone up. 2022, it's slightly gone up, but then it's started to break down all over again. Again, ever since October of last year, everything's been going up. Who knows if the Fed's been buying everything and trying to, prop up the market. But again, the bullish market, everybody becomes a genius. And it's the real geniuses that are in the bear markets that know how to stock pick and make the right moves and the right decisions during hard times. So if we look at the 5 year, it looks like they're just breaking even pretty much, and they're just in that fight mode around $32. I don't see much potential in this stock. The last 3 months, well, it's not giving me. The last month it's been going up, and again, the last 5 days it has been going up. But that can all change, at the turn of a dime, as they say. So, moving on from that, looking at, I'm trying to see the analysis for a bit. So here we have, based on 22 analysts, obviously buy ratings. I'm not that optimistic on the banking sector, so I'm very neutral about it. 50% of them said hold. These analyst price targets, I don't see a range for the red. I only see for the green. Obviously, they're trying to be greedy for a sector that doesn't really have much potential. We have here the quant ratings. Overall rating 3 out of 5. I don't know what to think of it. I got to look at more fundamental analysis. So we have here quality measures, 5.3. Highest rating is a 6.8 for the income. Comparing as a whole, throughout the whole stock market, no, highly doubt it. Comparing to the sector, no, I highly doubt it. And then comparing it to, I don't know what else to compare it to, the income, but again, it's not pretty high. Momentum, I can agree. I wouldn't say with that number, but more or less it is pretty active. So, if I was to choose the highest rating out of these 5, I would say momentum is the one that stands out to me the most. Growth would be the one that's the least. So the technical analysis for this, for the short term, it looks bullish. Medium term, it looks bullish. Long term, I don't know why they're saying weak bullish. It's hard to say that it's going to be bullish or bearish because we're only 2 months in the year. Really, March just started, so we still have a long way to go. I'm sure there's going to be further revisions, but I just don't get why they have to choose, bearish or bullish, and they can't be a little bit neutral for the technical analysis. So, moving on from that, now we're going to see the fundamentals and more financial data based on the numbers that we have. So, we have here not beating estimates. I mean, look at that drop. And then even though it's slightly more in Q1, they upped the revision. Again, they lost the last 4 estimates. So I'm not going to look at quarterly. I want to look at annually. So ROA was 0.72. That's a horrible number. ROE close to 7. Earnings per share 3.1. Net margins 20%. That's pretty high. That's pretty good. Typically lower on debt than other companies, but again, it's still not too bad. Net income is at 1.61. Total revenues at 8.22. So we have here their balance sheet 89%. Most important factor, the cash flow. So in 2023, we have about 3 billion. And then we have about 8 billion. Let me see. Yeah, about 8 billion. A little more than 8 billion in total. So they do have positive cash flow. This company seems all right based on the cash flow. They can definitely afford the dividends. I don't know. I can't do the math in my head comparing the total payout compared to the cash flow. But they seem to be doing okay. And again, this is a mid-cap company. I mean, it's still rather on the small side, but again, it's not too small, like extremely small, like micro or anything, but still, they're doing okay. This company seems to be doing okay. Would I add this to a watch list? Definitely not. I would not add this to a watch list, considering the banking sector as it is right now. Just not worth it. Next one up, ticker symbol LOB, and this will be the last one. So we have a volume that's very inactive. Market cap is almost 2 billion. Very small company. We have here dividends of 12 cents. That's like horrible. Earnings are 1.6. That's pretty low. 52-week high and low. Pretty respectable. But again, it's not enough to say that, wow, this is a company that looks okay. Share price is at $39.91. Next earnings report will be in April. I don't really care, to be honest. I'm here for the numbers. Looking at this first page, I mean, it needs some work. Not a lot of people are interested in the stock based on the volume. The dividend is horrible. Yield is horrible. They just need a lot of work. If they're surviving, then yeah, I'm sure a lot of people are not, looking for this as a quality stock or even in general just to pick it on their watch list at all. Last 5 years, I mean, look at this. In 2021, obviously you had a big rip. In 2021, start of 2022, obviously downtrend. 2023 overall was a decent year. Obviously it was a down year for the most part, but again, the last 2 months just ripped through everything and took everything out. The start of this year is pretty mixed. Slightly more on the bullish side, but again, it's slightly mixed because January didn't break out that fast. It took a little while for it to break out. That was the whole February bullishness that happened. So again, we have a low in 2020 of about so the last 5 years about, I don't know, $19 and change. Uh, Definitely above $19, but it's still fighting that range from 2022 of about $31. I mean, yeah, it's slightly above it at 39, but still. Then we have these large scale orders. I mean, change on a dime. I mean, this is insane. These are really big orders. So moving on from that, we have the quant ratings. So we have 5 analysts. 3 said hold, 2 said buy. So majority says buy. I sincerely doubt that. I would hold off on it. I wouldn't even bother with it. Income, yeah, I agree with that. It's pretty low. Growth is pretty low. Value, I say it's pretty low. Quality, I'm not too sure. Momentum, is pretty low. So I definitely disagree with that momentum number. Overall rating 1 out of 5. I do agree with this number. It's pretty weak. And then price ranges, there's a lot of bullishness on it. Then we have financial data here. We have Q1, Q2, Q3. A bit of mixed earnings here. Q1 for 2024, we have 28 cents. Then we have ROA for 2023 at 0.7. ROE is at 8.62. It's not bad, but again, ROA needs work. Earnings per share 1.6. As you can see, compared to the last 5 years, it is pretty low. It's lower. It's getting closer to the 2020 earnings. Net margins. So net margins have dropped. You can see it's clearly dropping the last 3 years. Getting back to 2020 numbers. It's still a decent number, but again, it's dropping. So debt to assets is 92%. 92% in debt. Slightly higher than competitors and other banks. Looking at the net income, 73 million compared to their revenue, we have 457. So that's not bad. Those aren't bad margins. Comparing those differences, then we have again 92% debt. So we have 11.27 billion in assets and 10.37 in debt. Cash flow, we have 620. Investing, we have negative 1.77. And then in financing, 1.32. They're pretty much slightly breaking even, slightly on the negative side, but they're pretty much breaking even on their cash flow. So it's not really good to see that. And then for them to pay a dividend on top of that, I know it's only 3 cents, but again, you count millions of shares. It doesn't look so good. So anyhow, I'm gonna say no to that stock. Ticker symbol LOB. Would I watch list this? Again, I'd say no to this company. And that's all I have for you guys. I'm not gonna go over the shareholders and institutions and all that. Who's holding this stock? Because again, the numbers prove that it's just not a good investment. So there you have it. Thank you guys for watching. I'll see you guys in the next one.